Hey everyone, welcome to the November 2024 real estate market update for the Las Vegas Valley. I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people build wealth through real estate by creating better understanding of what's actually going on in the world around us as it relates to the real estate market, so you are more informed, better consumers of real estate information, real estate properties, whether you're on the buy side or the sell side. So every month I give a market update. I give the market update based on what's actually taking place in the market with data collected on the 7th of each month. That way I get comparability across time. I also isolate the videos to only those resale transactions that took place or pending to take place, as opposed to also looking at some new home construction, because I don't want the data to be corrupted with noise. And so this is the most accurate version of real estate data about the Las Vegas Valley that you're going to find anywhere. That's published in newsprint, that's published on blogs, that's published in video form. Wherever you look, this is literally the most accurate view you will get of the real estate market in Las Vegas. So if you're here in the Valley, great. This empowers you to make better understanding, better decisions about where you may want to move around the Valley. If you're not here in Las Vegas, that's okay, that's great. This gives you a better understanding of what's actually taking place here in the Valley and how you may benefit by moving here as a relocation, by buying here as an investor, by exiting if you were wanting to exit, if you are actually in the process of leaving the Las Vegas Valley. So with that introduction, let's go ahead and dive into the numbers. I will tell you some rather interesting stuff took place in real estate in Las Vegas in October of 2024. Remember, this is the November update. We look at the data for the month prior, so October of 2024, and we do comparisons between the last month and the month prior, so we can see what the trends may be across a short period of time. We also look across the year, so October 2023 to October 24, so that we understand what's going on across a larger time frame as well. Okay, now let's dive into the numbers. First number I always look at, price. What happened with the median sale price here in the Las Vegas Valley in October? Well, it was flat. It was flat. This is actually really interesting. We are at $470,000 on median resale sale price for Las Vegas, for single family residence. What that means is actually we've had 4 months in 2024 where we were at $470,000. Now, on the one hand, that might make 2024 seem like a very stable market, right? So we were at 470 in October, we were at 470 in September, we were at 470 in August, and we were at 470 in June. Now, in July, we had spiked higher. For a single month, we had spiked up to 480. That 480 in July of 2024 actually reached the exact peak of 480 that we had seen in the prior run up in prices, and that was in May of 2022. So over a just barely 2-year period of time, we had gone down some, we'd gone back up, and we re-achieved that peak. Since that peak has been re-achieved, we've come back down to the 470. Now, we've been sitting at this 470 number, and I will point out to you, we've been above 470 in the entire history of the Las Vegas Valley only 4 times. Once was in July of 2024 when we were at 480. Once was in May of 2022 when we were at 480. And on each side of that May peak in 2022, we were a little above 470. Sort of on the way to that prior peak and coming back down from it. So we're really high here in terms of historical numbers in the Las Vegas Valley at this 470. Are we at the peak? No, we're not. We're almost at that peak, right? And in fact, because in July we had gone from the 470 in June to 480 in July and then come back down to 470 in August, that $10,000 gap that could easily be closed in just a single month. Now, will that happen sometime during the remainder of 2024? Or will we end 2024 at 470, a little below 470, a little above 470? I don't know. I'm not making a prediction specifically about that right now. We've entered into what normally is the seasonally slowest time of year with November and December. And so we can see a statistical phenomenon referred to as a small number problem. The smaller the number of activities that take place, the N, the smaller the number of occurrences of something, each individual occurrence can skew pricing information significantly. So we'll find out what happens with pricing in November and December as we go forward in time. We have some things that give us insight to that, but right now we're just looking at pricing of what did happen in October, flat at 470. Now, we are up 6.3% year over year, so October 2023 through October 2024, we're up from 442 to 470. That's a gain of 6.3%. And year to date, so January of 24 through the end of October of 24, we're actually up 7.6% because we saw a small drop at the end of 2023 relative to what had been happening the rest of 2023. So right now we're up 7.6% year to date in 2024. Now remember, normal market, we would be up sort of averaged across all time in Las Vegas Valley. We would be up about 5 to 7%. So our market this year in terms of pricing remains above the average typical year in Las Vegas. Okay, now I do look at price in one other manner because it's helpful to understand some of what's taking place with the internals of the market. And so that is, I look at price per foot. Price per foot, $259 in October. That's flat. It's flat from the $259 in September. Now, that's good. I mean, at median sale price, we were exactly flat. At median price per foot, we're also exactly flat. So that's telling us that the overall market in October was behaving pretty consistently across all of these single-family market segments. So high-priced properties, low-priced properties, middle pricing of properties. They were behaving, with this number, it gives us some indication, they were behaving all very similarly. However, year over year, the price per foot number is a little bit different. We get some divergence here. We're up from 247 in October of 23. We're up 4.6% for price per foot year over year, where we were up 6.3%. So almost 2% higher on median sale price. Why do we see this? It's because, as I've alluded to of the prior months, we've been seeing, especially earlier in the year, significant challenges in the upper half of the market relative to the lower half of the market. And that's been for a variety of reasons, but we could think of them as being the opportunity cost to purchase a high-priced property for somebody who may be buying with cash has been greater when when buyers have been able to get maybe better returns in other assets than they potentially could have on a single-family home. And so for those who are reliant on the mortgage market for buying, less of a challenge, interestingly, conceptually, maybe technically harder, but conceptually easier. And so we saw prices going up for properties below the median, that lower half of the market, more strongly than what we were seeing on the top half of the market, especially earlier in the year. And so we're seeing that reflected still. We've recovered some of that, and the upper end of the market's behaving similarly to the lower end of the market right now, but we still have this gap. Okay, so that's interesting information. That's about pricing in this market. If you will, pricing is this derived piece of information about how buyers and sellers are interacting in the marketplace. It's a derivative of the supply and demand phenomenon. How much supply there is tells us something about the power that sellers have. How much demand there is tells us something about how much power buyers have. That means we could think of the collective group of buyers as having some significant control, but for each individual buyer, they're competing with all the other buyers out there on a limited supply, and that's going to be pushing prices higher. So the stronger the demand and the weaker the supply, we expect prices to be going higher. Conversely, if we've got a lot of supply and weak demand, we would expect prices to be going down. Well, what do we actually have in the Las Vegas real estate market? Generally speaking, we have a surplus of buyers relative to sellers. Good to know is background information. Well, what happened in the month of October of 2024? The way we measure demand is based on number of units sold and number of contracts that have been entered into that have not yet closed. So for sold, we had 1,695 resale single-family homes sold at that median sale price of $470. That was up 10.6% from 1,532 that had sold in September. So that's actually a really strong indicator of demand in October, right? We had 10% greater sales than what we had in the prior month. And a sale does not take place without a buyer. You could argue sales don't take place without sellers as well. True, but we have more direct measures for inventory than we do for number of buyers who are floating around in the space, in the marketplace, looking for things, having money in their pocket and willing to make a purchase transaction. So sold transactions is our measure for one of our two measures for demand. Okay, so we're up 10.6%. This is in line actually with the prior month's pending sales numbers. So that's good. This suggests that pending, looking at pending, which is the next data point we look at, a demand measure, is still giving us good information about what may be coming forward with regard to sold for the subsequent month. So last month in September, we saw that pending numbers were good and they were stronger than sales. And I'd suggested that means October sales likely go higher. And so that's exactly what we saw. And so October sales up 10.6%. We're also up 10.5% from October's sales in 2023. We had 1534, and again, we went up to 1695. So that's actually strong indicators of demand. And I want to point out that demand is occurring in an unfriendly, I don't necessarily want to say hostile, but an unfriendly mortgage interest rate environment. And so I want to take a minute just to look at some of the numbers as related to what some people refer to as affordability. I look at it as being indicative of what's going on with interest rates and cost of housing because of interest rates. So we know that prior peak at $480,000 in May of 2022 came at a time where interest rates had started to really move higher. But they were moving higher from a very low point. And the Fed had only just recently at that time started to move interest rates higher, specifically the Fed funds rate, not mortgage rates, but mortgage rates tend to move sympathetically with the Fed funds rate. At least that's what we always believe in the mortgage, or rather the general bond marketplace. So interest rates at that time were 5.33%, average across the country according to the Mortgage Bankers Association. Well, that $480,000 purchase at a 90% loan to value, meaning somebody put in 10%, $48,000, and someone borrowed the remainder, so $422,000 mortgage. That cost, principal and interest only, $2,391 per month. Well, interest rates we know have gone considerably higher since then, and we know that interest rates had actually gone well over 7.5% for a period of time in 2023. And that was really impacting the cost of mortgages and therefore really restricting the number of transactions that were taking place in the marketplace. Okay, but we started to see in 2024 something different happening with mortgage interest rates. We saw mortgage interest rates come down slightly to around 7%, coming slightly below 7%, fluctuating on a monthly basis. We actually spent almost all of the first 6 months of 2024 with mortgage interest rates sort of between 6.8 and 7.1, so fluctuating in that range. Well, so we know that in July of 2024, we reassumed that prior record high price of $480,000. So you could get a median home on the same terms, except for interest rate. So $480,000 with 10% down, 90% loan to value loan. But interest rates, according to Mortgage Bankers Association again, average across the country in July of 2024 had gone up from that 5.33 of May 22 to 6.83 in July of 2024. So sitting just a little below 7%. So we were on the lower end of what was going on with mortgage interest rates as we were fluctuating sort of in this small band, a little below to a little above 7%. Well, that meant that the same priced house cost $3,119 principal and interest only for that 30-year fixed rate loan. This is $748 more per month than what was being paid on the same house at the same purchase price in May of 22, 2 years later in July of 2024. That says mortgage interest rates have a really significant impact on the cost of carrying a property. And since about 3/4 of all buyers buy with mortgages, that means that 3/4 of buyers are being exposed to this real significant impact with mortgage interest rates. Okay, well, that's July. What about in October of 2024? In October of 2024, prices had come down over, in August and held steady at $470,000. What happened to mortgage interest rates? Well, mortgage interest rates were coming down some in the later summer, early fall, and then the Federal Reserve in September of 2024 decreased the Fed funds rate by 50 basis points, by 0.5%. A lot of people thought that meant mortgage interest rates would be moving lower. Did not happen. The bond market reacted differently than what the Fed was trying to accomplish, and so mortgage interest rates, along with Treasury rates and others, went up. So where were mortgage interest rates in October? Well, they were 6.81%, down from 6.83% in July. So approximately exactly flat. $470,000 purchase, 90% loan to value loan, that meant $3,067 to buy, principal and interest only, to buy the median home in Las Vegas in October of 2024. That is down $72 per month from what the median was in July, when the median sale price was $10,000 higher. So waiting for interest rates to come down 2 basis points to 0.01%. And we saw prices come down $10,000. It saved $72 per month on the monthly carry cost. we're still almost $700 a month higher than what we saw in May of 2022 when prices were $10,000 higher, but interest rates were 1.5% lower. Now, I tell you that because I want you to understand mortgage interest rates have a really significant impact. So, mortgage interest rates fluctuate, and they fluctuate sometimes fairly quickly. So, the numbers that we saw for number of transactions, number of sold properties in October, well, those were largely contracts that had been written in September. Prior to September 18th, when the Fed cut the Fed funds rate, we had seen mortgage rates coming down because we'd seen the entire bond complex coming down in terms of interest rate, actually going up in terms of price, because price and interest rates are directly inversely correlated. So as interest rates had come down, we saw more people moving into the market as buyers, as demand participants, and they were writing additional contracts, which we saw closing in September, but even more we saw becoming pending contracts in September. Well, once somebody writes a contract, they have to go through the escrow process, and part of that is they have to go to their bank and fill in the application. At that time, people are locking their interest rates. So most of the transactions that we saw in October were actually occurring at lower interest rates that had been achieved in September, not at the October interest rates of 6.81%. So an interesting thing to think about, we did see interest rates coming down, and that goosed sales in October. Unfortunately, second half of September, all of October, actually for the past 7 weeks as I record this video, interest rates have been going higher again. Well, what's that going to mean for looking forward in time to the next month's closings, to November's closings? Well, we got some insight with that, looking at pending, right? That's the other demand number I look at, pending contracts. That's how many contracts were written, but have only gone into escrow, have not yet closed. Everybody in pending is going through the process of filling in their bank loan application, locking their interest rates, getting inspections done, getting appraisals done, all those kinds of things. Well, pending contracts in October, 1,745. That's up. It's up less. It's up 4.0% from the 1,678 that we had seen written in September. It's also up substantially year over year. It's up 26.0% from the 1,385 that we saw in October of last year. Now, this is significant because it means there's still, even through the month of October, even as interest rates have been trending back higher, we've been seeing some demand in this marketplace with contracts being signed. That's good, but clearly interest rates are not helping this situation. Now, I do want to point out, because pending contracts written, 1745, is 50 contracts more than closed in October. It's possible we actually see, when November's statistics come out, a slight gain in closings in November relative to October. Now, these are pretty marginal numbers, so it may be we're actually just flat. It may be that we're down a little bit because of collapse of contracts or things like that. But it does say that there's the potential November sales could, some people would say, surprise on the high side. I don't know it's going to be any kind of surprise because we have the statistical activity that would support that. But we also have the increasing interest rates that may be causing some people to cancel contracts. I'll tell you, for example, I've got a client who, as I record this, has been in contract for the past 2 or 3 weeks and has been waiting to lock interest rates until after the November meeting of the Federal Reserve, which occurred the day prior to my recording this video. Interest rates are still going higher. And so my client was talking to me yesterday. Their loan is going to be about 0.5%, 50 basis points, more expensive than what they thought they were going to get if they had locked when they entered into contract on the purchase of the property they're going to close later this month. So they can afford that. That's great. They were exposing themselves to interest rate market fluctuations, contrary to my advice to them. But that's fine. They were wanting to do that and willing to do that. But it means that people who are going into pending contracts later in the month of October were already sitting at higher interest rates, and there could be some significant impact of those higher interest rates. Remember as well, we just had an election. The election reduced a lot of uncertainty. It's the outcome of the election is interesting. The good thing is it's not contested, so that reduces a lot of uncertainty. However, the winner of the election, there's some significant lack of understanding about what actually may be the policy outcomes from this election. So we'll see how that unfolds over time. But let's say electoral outcome uncertainty has been significantly mitigated, but we're still walking into the slowest seasonal period for the year, and that is the holiday season, November, December. And so we normally see sales decline significantly in November and hit the bottom of the year in December. So we have those real headwinds facing us as we move into transactions for November and again for December. So I caution you with that. Pendings did in October go slightly higher, 4%. They are 50 higher than what we saw for solds in October. Those are both good indicators. They could be swamped and we could still see sales coming down in November. All right, so those are our demand measures. How many buyers are in the market actually willing to enter into a contract? So what about our supply measures? Well, those are sellers who put their property up for sale, either as standing inventory, meaning it's sitting in inventory waiting to be sold, or is a newly listed into the market during the course of the prior month, the course of October. So let's look at those numbers. For sale inventory, 5,659 at the end of October. That's down. It's down 2.9% from 5,827 at the end of September. So that's weak. It gives us a supply number that's just a little below half of what we would see in a normally functioning market. Supply has been very low all year. In fact, supply has been very low except for the third quarter of 2022. Supply has been very low since a little before we went into the pandemic. So supply started low to move lower in 2019 and just really collapsed in 2020. And that's been the environment that we've been living in since that time. Okay, now we are up on total inventory from 5,089. We're up 11.2% from October of 2023. So just gives you an indication of, again, we've been in this low inventory environment. There's not really anything new here, except that inventory is not growing, right? That's the real insight. Supply is very constrained and it's not growing. Okay, now I want to say something else, and I commented on this the last month or two with regard to inventory. And that is, I can look in the multiple listing service, you can look on my app, you can look on Zillow, Realtor.com, Homes.com, wherever you want, and you can see all of the houses that are posted for sale in the Las Vegas Valley. And that's the standing inventory. That's what's for sale out there at some particular period of time. I use the multiple listing service because, one, I'm a member. It gives me easier, quicker access to a whole host of information that may be harder to get on some of the commercial sites out there. Homes.com is probably the best. Realtor.com is probably the second best. Zillow is actually becoming less consequential, interestingly, over this past 18-month period of time. But if you go onto homes.com, you can look and you can see how many houses are listed for sale in the valley. That's inventory. Okay, the problem is that's sort of an unqualified view of inventory or supply. So the past couple months, I've been trying to qualify the validity of those inventory numbers so that I can actually let you know how much is really for sale, how much is just fake listing, and that way we know a little bit more about supply numbers, and we know a little bit more about how sellers are thinking of this market relative to buyers and how they're thinking of this market. We know buyers put into contract 1745 and closed another 1695, and they did it at the median sale price of 470. Well, what are sellers actually looking at? Well, it turns out the median list price, that's the price sellers have posted for their house for sale, is not 470. It's come down from what we saw in September, which is good. It came down $5,900. Okay. The median list price, $564,900. That means it's only just about $95,000 too high relative to the actual sale prices. Now, as I said last month, and I think the month before, that does not mean everything in inventory is $100,000 too high. It does not mean that there are no good transactions to be found within the inventory. It simply means that at the median, prices are way more expensive for sale than what the market is actually accommodating. So if we were to renormalize all of the inventory with a new median list price of 470, there's not really 5,659 houses for sale that are realistically priced. There's 3,136. So that's just about 30% of normal inventory, normal supply, is what we see sitting in the market at this time. Supply is really, really constrained, right? And so supply came down. We're still $95,000 too high on median list price, and normalizing median list to median sold price means we're actually sitting at just at less than 3,200 houses for sale in the Las Vegas Valley. Right? And the other houses, you're wondering, well, what happens to that other 2,500 homes that are sitting there that are above a median list equal to a median sale price? They languish on the market. There are houses that are out there right now that literally are going into contract in 1 day, 2 days, 3 days with multiple offers. And there are also houses out there that are racking up 270, 365, 450 days on market. They're not real, right? They just sit there, maybe looking pretty, with a little sign on them that says, "Come look at me, but don't buy me, don't touch, because you're not gonna like some of my features, like my price." Right? So they're fake, they're illusory. All right. So the other way we look at supply is newly listed during this past month. So newly listed houses that came into the market, resale houses that came into the market in October of 2024, 2,743. That's down, also down from 2,778 that we saw come into the market in September. Now it is up, it's up really substantially, 20.1% from the 2,283 that we saw coming into the market in October of last year. Last year, not only were supply numbers very low, interest rates were still heading higher, and that was having a bigger impact on the market, both for sellers and for buyers. Then as interest rates have been holding steady or going down a little bit or heading back to this channel that they've been in for almost the entire year, right? So we could say that even though interest rates have gone back up for the last 7 weeks as I record this, the reality is interest rates have been, with the exception of about a 4-week period of time, remaining in this channel of sort of 6.8 to 7.1 throughout 2024. High, fluctuating, relatively stable. So as interest rates were going higher last year, that was really devastating the economy. This year, we're actually seeing the high interest rates being accommodated by both buyers and sellers somewhat. All right, so that's what's going on in the market right now. Now again, I'll point to seasonal patterns looking at us moving forward through November and December. I think we're going to see inventory drops significantly through November and December because that happens every year. I don't think this is a typical year, but we still have the typical psychological and sort of physical issues sitting in front of us with who wants someone looking at your house while you're trying to serve Thanksgiving dinner, who wants to move out of your house just the day after you put up a Christmas tree or a menorah, which you now have to take down and move out of your house. So the holiday season's really slow for transactions, really low for inventory every year. And I think that we're looking at that going forward through this year because interest rates have not been coming down to swamp that issue. And while uncertainty around the election itself has now been eliminated, we have significant policy uncertainty looking us in the eye. We also have the question of what's going to happen in the middle of December with regard to the federal government budget. The continuing resolution that was passed in October funds the government only about halfway through the month of December. Something Congress is going to have to deal with between now and the middle of December, funding the government either through maybe the end of January or for the entirety of fiscal year 2025, which we're in right now. So we do have still some heightened uncertainty in the marketplace. All right, one other statistic that I've been giving every month since 2020, and that is back on market. In October of 2024, there were 657 houses that came back into the market. That means they'd gone into contract, they'd become a pending, and the contract failed, escrow failed, and houses came back into the market. Now, as I've noted over the past several months, some houses that fall out of contract do not go back into the market. They disappear from the market. And so this back on market number is accurate, but in terms of contract failures, it's only a proxy and it understates contract failures by some unknown amount. So this is actually a conservative way to look at contract failing. That's 27.9% of all contracts failed in the month of October. This is a devastating number, right? It's a little bit below where we had been a few months ago, but we've been between 25 and 33% on contract failings for more than 4 years now. Normally functioning market, something around 10%, right? Maybe 8 to 12%, maybe slightly higher, spiking up to 15 occasionally. This is really high number of back on markets, really high number for contract failings. So keep that in mind. All right, so every month I put this kind of information out so that you are more informed about what's going on in the market, having real knowledge about the real data. I am Justin Miller with the Chong Miller Group, and if you find these insights, these data points to be helpful and interesting to you, please subscribe, hit the notification bell, like the video, etc. But more importantly, please share these videos with your neighbors, your friends, your colleagues, your family members. Think of this a significant informational gift that you could be giving them, since we're in gift giving time of year, right? This is really significant information. I'd be happy to help you. I'd be happy to help those people that you know who could benefit by really good professional representation in the real estate market, whether it's helping directly or at least by providing the knowledge that is available through these videos. All right, real good. I will see you in the next video. Thank you very much.